Hello and welcome back to Explain the Charts, your go-to channel for detailed market analysis. Today is October 26th, 2025, and we're taking a deep dive into XAUUSD, or gold, which has had an incredibly volatile week. We just saw gold scream to a new all-time high, only to be brutally rejected, and now the market is holding its breath ahead of a major economic data release. First, let's cover the news driving the market before we get into the charts. The fundamental backdrop for gold has been overwhelmingly bullish lately. We have an ongoing US government shutdown, now in its 24th day, which undermines economic confidence and boosts demand for safe haven assets like gold. Additionally, persistent trade tensions between the US and China continue to simmer, with high-level talks scheduled for later today, adding another layer of uncertainty. Perhaps the biggest driver is the market's conviction that the Federal Reserve will cut interest rates. The CME FedWatch tool shows a staggering 97% probability of a rate cut in both October and December. Lower interest rates decrease the opportunity cost of holding non-yielding assets like gold, making it more attractive to investors. However, it's not all one-sided. We're hearing whispers of a gold bubble and have seen some capital rotate into assets like Bitcoin, which recently surged as gold prices wobbled. The main event everyone is waiting for is the US Consumer Price Index, or CPI data, for September, which is due out later today. This inflation reading will be a massive catalyst and could determine gold's next major move. Now, let's pull up the daily chart and see how this news has been reflected in the price action. Looking at the past couple of months, you can see a powerful uptrend that began in early September. This rally culminated on October 20th with this massive green candle that printed a new record high of $4,381. This was the moment of peak euphoria, driven by all the bullish factors we just discussed. But what happened the very next day, on October 21st, is critically important. We saw a colossal bearish engulfing candle, erasing all of the previous day's gains and then some, with a staggering drop of over 6%. This is a classic sign of a market reversal, indicating immense selling pressure and profit-taking at the highs. Following that massive drop, the price has been consolidating for the past 3 days, trading within a progressively tighter range. This tells us the market is in a state of equilibrium, with both bulls and bears fighting for control as they await the CPI data for direction. From this daily perspective, the key resistance is now the all-time high around $4,380. On the downside, the low of that massive red candle, around $4,077, serves as the initial major support. A break below that level would open the door to testing the psychological $4,000 mark, which news reports have highlighted as a critical level. Let's switch to the 1-hour chart to get a closer look at this recent consolidation. Here you can see the epic rise and the dramatic fall much more clearly. Since the bottom of that crash on October 21st, the price has been forming what looks like a symmetrical triangle. The highs have been getting lower, and the lows have been getting higher, coiling the price into a tighter and tighter apex. The upper boundary of this pattern is right around the $4,150 level, while the lower boundary is holding strong near $4,040. This matches the analysis from FX Street perfectly, highlighting these two levels as the key breakout points. A break of a pattern like this, especially after such a large preceding move, often results in an explosive move in the direction of the break. Volume has been tapering off within this pattern, which is typical as traders wait for a catalyst before committing to a direction. That catalyst is almost certainly going to be the upcoming CPI release. Now, if we zoom in even further to the 15-minute chart for the last trading day, October 24th, we can see just how cautious the market has become. Look at this tight, choppy, sideways price action throughout the entire session. The market barely moved outside of a narrow range between roughly $4,044 and $4,144, essentially respecting the boundaries of the larger triangle we saw on the hourly chart. This is the market in ultimate wait-and-see mode. No one with significant capital wants to place a big bet just hours before a pivotal inflation report. This lack of conviction reinforces the idea that the CPI data will be the trigger for the next significant move. So, Let's bring it all together and discuss the potential scenarios heading into next week. The long-term fundamental picture remains bullish for gold, with geopolitical uncertainty and expected Fed rate cuts providing strong support. However, the short-term technicals show a major rejection from the highs and a market that needs to prove it can push higher. Our bullish scenario hinges on a decisive breakout above the triangle's resistance at $4,150. This would likely be triggered by a weaker-than-expected CPI number, reinforcing the idea of imminent Fed rate cuts. If we get that breakout, the first target would be the former support zone around $4,220, with an ultimate goal of retesting the all-time high near $4,380. Given the macro tailwinds, I would assign a 60% probability to this scenario, provided the CPI data is favorable. Conversely, the bearish scenario involves a breakdown below the triangle's support at $4,040. A hotter-than-expected CPI print could cause this, as it might make the market fear the Fed can't be as dovish as anticipated. A break below $4,040 would immediately target the psychological $4,000 level. If that support fails, the next major target would be the October 9th and 10th lows, down around the $3,945 area. I see this as a 40% probability, as it would represent a significant failure after such a strong run. To recap, the most critical levels to watch are the boundaries of the current consolidation, resistance at $4,150 and support at $4,040. Key downstream levels are $4,220 and $4,380 to the upside, and $4,000 and $3,945 to the downside. The primary thing to look for is the market's reaction to the upcoming CPI data release. Watch for a high-volume break of the consolidation range to confirm the market's intended direction for the coming days and weeks. Thank you for watching this analysis on Explain the Charts. Please remember, this content is for informational purposes only and should not be considered financial advice. Trading involves significant risk, and you should always conduct your own research and consult with a professional before making any investment decisions. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell so you don't miss our future updates.